I enjoy coming to work every day knowing that clients are depending on me to guide them through whatever financial needs they have.
Every client we have is different. And so it's really about finding out what's really the most important.
Hello, my name is Steve Jablonski, and I'm the host of Financially Speaking with Jeff Bush. We have a very exciting topic today. Here we are halfway through 2022, and markets have been very, very volatile, and as of this morning, the three major indices, the Dow Jones, the S&P 500, and the NASDAQ are all in bear territory. So today's topic is investing in a volatile market. With that said, Jeff?
Yeah, so, hello, Steve. Welcome to the show. That was a good introduction. This is really a good time to do this show as we are in a volatile market, and hopefully we can be the voice of calm and the voice of reason as we do this show here on PCTV and the PCTV network. And we've been doing this show for a long time. We're 9 years almost doing this show. And of course, when we started this show, we were doing it across town at Pottstown High School. And of course, now we do them right here in our Pottstown office, in our Pottstown location. Investing in a volatile market. So, Steve, I think this is an important topic. It's a timely topic, obviously, because the markets are so volatile. And I think in our career, we've seen this before. This is not new to us. The narrative is different. There's always a different story behind a downturn in the market. This one is really it's a cause of inflation, rising interest rates, which we haven't seen in quite some time, and of course the struggles and the strife over in Eastern Europe. Those are some of the things, and of course we're coming off the pandemic, and I think that has a lot to do with it too. And it's just really kind of doing some weird things with with the economy and with the stock market. So I think this is a good time to just let people know what our principles are in getting through this difficult time.
And with our Wellspring formula, we have the Venn diagram, and really we have what matters, and then we really have what we can control. And very, very important in calm years with the market, but especially important now when we see the volatility, and we help coach people not make incorrect decisions. So with that said, I'll turn it over to you a little bit about how this is very, very important today.
Well, so we created the Wellspring formula a couple years ago, Steve, because we felt that it was important to kind of highlight some of the planning that we're doing. And when we created the Wellspring formula, one of the things that we did is we created this Venn diagram, and this goes back to the days of studying geometry, right? A Venn diagram. But if you look at this, there's two circles there. There's what matters in your life and what you can control in your life, okay, as it relates to financial planning. And what we found, and people intuitively know this, is that there's a lot of things you can't control. So the intersection of what matters and what you can control, that's where we live. That's where we've created the Wellspring formula. And there's the stock market. You can't control that, but you can control how you invest in the stock market, how you invest, period, and how you set up your plan, your financial plan.
And I know with Jeff, with control in our process, normally in our second meeting is where we go through, we use what's called Riskalyze, and we really look at someone's portfolio of where they are, and then we get a very good idea of where they are here as far as their risk. And what we see a lot of times is people's investments are taking on a lot more risk than where their true risk tolerance is. And the other thing is a lot of our clients, they don't need to take on that unnecessary risk to reach their goals. So we talk about that right up front with our clients, and and it's a whole education of how we invest with what we can control is the risk portion.
Yeah, well, it's really one of the pillars that we have of the Wellspring formula is risk and managing risk. And we have a whole process with Riskalyze where we have a scoring system. We have a methodology of determining what someone's risk is. And oftentimes we find that their investment portfolio is not aligned with where they fit on the risk scale. So one of the first things that we do is we try to make some strategic adjustments to the portfolio so that risk, the risk of the portfolio, the investment portfolio, really matches where they truly are. And when we do that, then I think people become a lot more comfortable with all these this stuff. Because the reality is that being in a bear market, as you pointed out at the top of the show, Steve, that in itself is not that unusual. And if we go back over the last 40 years or so, there's been several bear markets. I know you and I have been through many in our career, and some of them have been pretty severe and pretty significant and pretty long. Like I think back to the one in the early part of this decade in 2000. I mean, that was a long time. That lasted from I might not have the exact dates, but I think it was from like March of 2000 to like October of 2002. Yep. That sound right? It's about 2.5 years. That's a long time to be in a bear market.
And then we had the lost decade.
Well, yeah, because the lost decade, because then we had another one in 2007, and that one lasted. That was about 1.5 years. That lasted from like November of 2007 to like March of 2009. So that was, so when you couple those together, like you said, the lost decade, you have basically a 10-year period where the S&P 500 index was flat. So it was hard to make money in the stock market. So this is not, what we're going through is not new. Maybe the reasons behind it may be new and it may be fresh, and some people may have not invested through those markets, or sometimes people forget.
And with our clientele, our clients are very near retirement, so it's different for them now versus 10, 15 years ago, because the goal of retirement is right there now.
Well, I think we should talk about that for a minute, because we commonly refer to that as the second half of the game. Yep. Okay, so in the second half of the game, you're not taking the same risks that you're taking in the first half of the game. You're investing for, you're preserving your capital. You're doing more of the estate planning. You're doing more of the income planning. You don't have a job where you're getting a steady paycheck. It's a very different investment philosophy when you're in the second half of the game, and the risk is different.
And when we talk about financial planning, some people may be asking, what does financial planning have to do with investing in a volatile market? And
I think I asked that question earlier.
You did. That's a great question. And so what it gets down to is, with our clients, we really talk about what's important to them as a matter side. And when the market is going up, people don't question things. And then when the market corrects, if someone has a very solid financial plan, the discussion we have with our clients is, have your goals changed? And that's what it comes back down to. And if they haven't changed and we have them invested properly, we do have to ride these things out.
Yeah.
And we'll get into some specific products, but that's really the discussion is, have your goals changed? And if they've changed, that's a whole different issue. And then we can move some things around and make some big adjustments. Yeah. But if they haven't changed, we have them on a solid financial plan.
Yeah, and I think that's a good point. One of the strategies that we've used and have implemented over the years, and I think this answers the whole risk philosophy, is our asset cycle portfolio model. And we have a graphic of that. We can put that one up. But with asset cycles, Steve, I mean, it really, we're given so we're not looking at someone's investment portfolio as one investment.
Yeah.
We're creating different strategies, different silos, if you will, where every asset has a different job description. And the reason why that is so important is because if you're investing along a timeline, and then you can take risk when it's appropriate.
Yep.
So if you have investments that you're going to need to tap into for short-term needs, short-term planning needs, short-term income, that particular asset should have no risk, because you're going to be depleting that asset in a very short period of time. So therefore, you can't take any risk. There's no volatility, because short-term, predicting markets in the short term is tricky at best, if not impossible.
Yeah.
We can't predict what's going to happen in the short term. Once we get further out the timeline, then there's more certainty. We know how markets are going to perform over a longer period of time. So when we look at asset cycle, we have short term, then we get out to midterm. So midterm might be, we might define that as some maybe assets you're going to need to tap into for income, maybe from year 6 of the financial plan, maybe years 6 through 10. So since that's midterm, maybe you can take a little more risk. When I said a little more, mm-hmm. right? So maybe we can dip into the bond market a little bit, or maybe there's some other investment vehicles that we know are going to perform over that midterm period of time. So the significance of that, Steve, is that if you've got those two strategies covered, yep. those two buckets, if you will, short-term, midterm, now you're getting into long-term. Now you're getting into the long-term income, you're getting into growth. And that's where you can truly make some money in the stock market. Yep. Because now you have a longer term strategy. You can afford to ride out some of the volatility that we've been experiencing lately. You could take advantage of what the market can give you over a long period of time.
Very good, Jeff. And so now when we get into investments that offer guarantees, tell us a little bit about those and how do they work?
Well, I think the part of the philosophy that we have is that, again, if you want to have, financial planning is all about balance. So if you're going to have investments that are exposed to the equity markets, to stocks, then you should have also something that is safe. And this is a tool in our toolbox, right? So we get into things like fixed annuities, fixed indexed annuities, where principal is guaranteed, right? So if you look at what's happening now in the market, and you look at the, what did you say the S&P was down so far?
It's the S&P's. I mean, so just over 20, but I know the
20
when
we're taping
the
this.
NASDAQ is about close to 30.
Yeah. So if you're in an index annuity, and I'm thinking back to a couple that we put into play right at the end of the year, the early part of this year. Well, if you're in an indexed annuity and your principal's protected, you've just outperformed somebody that's been in, let's say, the S&P 500, or just say stocks in general, and their portfolio might be down 20% at least. Well, you just outperformed the stock market by 20% because you're in a strategy that's not going to lose money. And that might not sound very good when the market's going up, But when the market's going down or the market's going sideways, that has a lot of appeal. So the fixed index annuity is, and sometimes annuities get a bad rap because in my opinion, they're not used properly. So if you're using them as part of an overall plan, an overall financial plan, that's where they have some power, because they can provide some stability to a portfolio. And here's the other thing. Here's the other maybe I shouldn't use the word magic, but here's the other powerful component of an indexed annuity. If you look at the markets, remember how I said earlier in the show that every market's different? This market is experiencing not only downward trend in stocks, but also downward trend in the bond market. That in itself is somewhat unusual, that you're experiencing that. And so there's some reasons for that. We talked about inflation, we talked about rising interest rates. So what happens is these fixed index annuities can function, so they can beat the bond market too in this type of a market that we're in, because the bonds are so volatile. So I look at a fixed index annuity as another asset class. So another point of diversification. So if you have, you have your stock portfolio, you have your bond portfolio, and then you have another portfolio where you have some strong guarantees built in with a fixed index annuity.
So that guarantees the principal. Now, and we're one of our big focuses, because pensions have been on a steady decline for the last 20, 30 years, is guaranteed income.
Yeah, so the other key feature with a fixed index annuity, and even with some of the variable annuities that we use with our clients, is they have these riders, these income riders, these income benefits that provide guarantees of income. So it might, they're be based on your age and maybe your spouse's age. It's going to provide a guarantee. So that guarantee is, when I say guarantee, I mean for life. You're getting a certain amount of income and it's guaranteed for life. If you have that, we have found that our clients are less prone to be upset or worry, or the phone doesn't ring when they have these guarantees in place with these riders, because they know that their income is guaranteed. So having guarantee of income is a powerful tool, with financial planning.
And how often have you heard, and when we call our clients in these volatile times, oh yeah, Jeff, I have that one that has the guarantee.
Yeah, it's and these insurance companies are pretty smart, where they put these guarantees in there because it's really something that consumers want. They want guarantees. They want to have income that that they know that it's not going to go away even when the markets are volatile the way they are. This is going to pass, right? Like, we can't sit here today and tell people when, because we don't know that, but we know it will pass, because we know that the markets have an ebb and flow to them, and eventually we're gonna, inflation doesn't last for the high inflation is not going to last forever. It's going to go up eventually. It's going to level off, and then it's going to go down again. And with that, the markets, we're in a pretty strong economy. Before all this happened, we were sailing along pretty good. So I think once we get back to that, we'll be back to a nice, robust economy. But that's going to take a while. It takes a fair amount of, it takes patience and time to get through this.
And when we choose individual investments for our clients, Tell us a little bit about how that's done, or the independent channel.
Well, we work in a fiduciary capacity for our clients. So we're doing what's in the best interest of our clients, and the way we do that is, through, we have a process to do that, and we meet with our clients. We get to, initially we get to know what their goals are, their goals and objectives. Once we have that outlined, we can put a plan together, a financial plan. We put all kinds of data together, risk-alize, and we do, the asset cycle portfolio, and among other things. And once we do that, we put a plan together, and we select investments that are appropriate and in the best interest of our clients. So that's our fiduciary role. And as far as a little bit about our firm, we act as an independent. So we're not tied to any one company or any one product or any investment strategy. We can do whatever is the right thing for our clients.
And in the planning process, it goes back to the plan and their goals and not changing. How does the guaranteed income fit in the income model, for example?
Well, that's the first thing. That's the first thing that we have to define. Because once that's done, everything else will fall into place. But we look at, we'll look at what are the known income sources? What's the Social Security benefit? What's the pension benefit, if anything? Maybe sometimes one of the spouses is still working, so we have some income there. So once we define all that, then we put the income model together, because maybe we want to put some other guaranteed sources of income into place. And once we do that, then we can start to fulfill some of the other longer term objectives, long term growth, estate planning. Maybe we want to look at some philanthropy goals, but the guaranteed income, or the income model, is really key to this.
And I believe with informed family, a lot of getting through times like this is really the relationships that we build, and how we are continuously in contact with them.
Yeah, it's all about the relationship. I mean, that's we're trying to build that right from the beginning, because there's we have these strategies in place, but there's like this, we have to have a trust factor where our clients believe in us and what we're doing, the strategies that we're doing, because they're really entrusting us with their livelihood and a lot of the assets they've worked so hard to build up over the years, and now it's our job, our fiduciary role, to to make sure that we're carrying out all those financial goals that we've laid out for our clients.
And as far as someone looking for an advisor, what type of advice would you give them to build that relationship? What should they be looking for?
For an advisor? Well, I think the first thing, as we pointed out a little bit earlier, is the fiduciary role. I think that is critical. You want somebody that's really going to be looking out for you. And then I think it's one where you have to have a level of comfort and a level of faith in the person that you're working with. Like what we do is we have a process that we call FIT. So in other words, we'll sit down with somebody and we'll have that conversation about what the goals and objectives are, and what the financial plan is, the outline of that, what that's going to look like. And then we'll give the prospective client some time to think about that, and then it gives us some time to think about it, and our team some time to think about it, and then we figure out whether that is indeed a fit. So it's got to be a fit for us, and it's got to be a fit for the people that we're working with. And sometimes it's not a fit for whatever reason. Our goals might not be aligned. They might not fit with what our philosophies of what we do. So it's a whole process. So you want to make sure when you're looking for a financial advisor that you have someone who's who you're comfortable with, and as someone who's working in your best interest. So with all that said, one thing I want to jump back to is all the work that we've been doing in the media. We've been in the news with a bunch of different news outlets, magazines, and the KYW News Radio, and U.S. News and World Report, and the USA Today, and among other things. So just check us out on that, and of course, if you want to contact our office, come to one of our live events. We'll put that up on the screen too. We're now out and about and taking our show on the road. So you're welcome to come out and see us at a live event coming to a place near you. So with all that being said, I think that's a wrap on another exciting show. Steve, I want to thank you for all your input today, and this is Financially Speaking.